Hey guys, it's Jeff Gibby over at MetaStock. I hope you're doing well today. Good afternoon, good evening, good morning, whatever it happens to be for you. I want to welcome you to the class. We're going to have a good one today, focused on first hour breakout strategies by somebody I like and respect. And so let's go ahead and get to the legal disclaimer. Today's demonstration is designed to instruct you on using MetaStock and the accompanying software plugins. It's not a recommendation to buy or sell, but rather guidelines to interpreting and using specific indicators and features within the software. The information, software, and techniques presented today should only be used by investors who are aware of the risk inherent in trading. MetaStock shall have no liability for any investment decisions based on the use of their software, any trading strategies, or any information provided in connection with the company. So there you go. Welcome to the class today. Today we do have a special guest. Adrian and I have been doing some stuff together for years. He's spoken at a number of our events now, including our in-person events. He has a very, very interesting way of looking at the market. He's written a book that I have right here called Around the Horn, which uses baseball analogies to kind of describe different market conditions and different market sentiment. It's a great book. It's a very visual-based book. A lot of what he's looking at is very, very easy to understand patterns. So I want you to welcome him here. I'm going to go ahead and turn on his microphone here, if I can. Okay, I can. And then I'm gonna basically start to share his screen. Adrian, how are you doing today?
I'm good. How are you?
I'm doing great.
Great.
Let's see. Go ahead and do this. What do you want to? How would you like to introduce yourself? Let's start there.
Well, I'll start this, and then I'll give everybody sort of a rundown of who we are and what it is that we do around here. I'll tell you that the strategies that we're going to talk about are first hour strategies. And when I say we, I'm talking about that gal right there. That's my wife, Julie. So Julie and I have been trading together since we were in graduate school. So we started a trading business back in 1996. And we both went through and got our PhDs and our MBAs and everything. And, we were originally going to head out and do consulting work, and we thought we were going to be working with some big six consulting firms, and then we got into this, and by the time we were done, a guy named Peter Drucker was a good friend of mine. He was a business guru. He was on my committee at school, and he said, well, if you've got a profitable business, why do anything else? Why would you ever change what you're doing? So it's been just over 20 years that we've been trading the markets, and it's all that we do. And, we've also somewhere in about 15 years ago, I guess, or 10 years ago, we added the big trader education component to what we do, sort of to get us out from behind the screens and, do something other than just trading, meet people and do things. So we do speak at a lot of big events. We speak at big events. We speak at small events, enjoy meeting everybody. And we really have made the most out of all the travel and everything that we get to do to get out there and talk to folks and show them what we're doing. Over the years, our strategies went from, so a lot of you, if you guys have the Around the Horn plugin for MetaStock, then you know that, a lot of those trades, they can play out in the morning, they can play out over the course of the day. We have chosen recently to focus our energy on the first hour of the trading day. We've got a 10-year-old son, and we like to spend as much time with him as we possibly can. So we've shifted away from holding trades for the entire session to just holding trades for about the first hour so that we can just go out and enjoy life. And that's really what I'm going to talk about today, are the first hour trading strategies. Now, they're pretty similar to my other stuff. They're built on the other trading strategies. So if they look familiar, sound familiar, it's because they are. You can scan for these things with MetaStock. I'll show you how, sort of how I plug these things into my life in a second here. But that's us. That's a little bit about where we came from and what we're doing. And as Jeff said, I wrote that book. Around the Horn was written around a baseball analogy. Now, like I said, we're both researchers by nature, college professors by nature, right? That's kind of the route that we were going. The first title of that book was A Multivariate Analysis of Covariance of Data in the Equities Markets. So it was a paper, and it was going to be a very technical book that my publisher said, probably we would own 10 copies and my mother would own one, and other than that, no one was ever going to read this thing. So we went back and we reconfigured everything, and we made it a metaphorical book where we take baseball terms, right? I love baseball. I'm a Dodgers fan. Right? We're here in Los Angeles. Baseball is a big part of our lives. But I've taken the statistics out of most of the patterns so that what you see instead is just a very easy to understand, as Jeff said, visual representation of what goes on. Everybody doesn't need to crunch a ton of numbers every day to figure out, what a good expansion of range and volume setup looks like. So I'm going to show you that. That one's called Fastball. So Fastball is the first one that we're going to go over today. If you've got MetaStock and you're using the scanner, the way that I do, right, I trade with a different platform. What I do is I use MetaStock to scan for everything. I scan them all up. I go through, I look at them, I pick the ones that I'm going to trade, and then I input those into my trading software. And actually what I do is I scan for them at the end of the day. So that would be at the end of the trading day. And then I go through and analyze them. I haven't done it yet for tomorrow. I figure out which ones I'm going to put on my trading plan. And then I go and I enter them into my trading software tonight. And I just let these things auto execute in the morning. So I'm going to show you briefly here what a couple of the setups look like, the first hour trading setups. And then I'm also going to show you how I input them into my trading software for automatic execution and what the benefits and drawbacks of a couple different order types are. So your own platform is going to vary, right? I'm using the platform that I use is going to be very different than let's say you're going through Interactive Brokers or somebody. You're going to have to find out how to set these up to achieve the same effect. But I think you'll be able to do it, and I think you'll be pretty happy trading these things if you get a grip on them. So the Fastball expansion, first thing is this is an expansion of range and volume. I'm looking for, or MetaStock is looking for, when you run the scan, the days where the range is the widest of the past 10 trading session. Generally speaking, you want to go through then and validate that volume was also higher than the average volume of the past couple of weeks of trading. And then in the case of a short sale, I'll just go through what a short sale looks like. We want to see a move lower, and I want to see a close in the bottom 25% of the bar. So basically, if I'm going to short it, I want to see it open high and then close low. And the next day, I'll just look to enter a short sale 10 cents below that Fastball day bar, right? So 10 cents below the low of that bar. And what you do with your scan then, or what you do with the with the trading plan, if you're subscribing to that, is you're just going through and you're targeting underlying support. So whether I'm picking the support or you're picking it, what you're doing is looking at a daily chart to find where the bodies are buried, essentially, right? Where there's support, lots of highs, lows, opens, closes, that kind of thing, all aggregating. Just draw a line. And when you find the area that you think price is very likely to bounce from, that's going to be your target the next day for the trade. And I use overhead resistance on a short sale to establish a stop loss. And I do that from an intraday 5-minute chart. So 5-minute chart to pick the stops, daily chart to pick the targets. The example here is a short sale, but it's going to be the same kind of a thing for a long. Now, the enhanced criteria that I have here for this Fastball XRV setup, this is taking the data that I get from those scans and then pushing it even further, right? So I go through and do a lot more analysis on these XRV setups, and what I'm looking for is signs that the expansion of range and volume is being driven by an institution that's engaged in a markup or a markdown of the stock, right? They're either buying it or selling it off. And, we're going through and doing things like filtering for market maker activity so that it's the same, is the same entity going through and buying and buying over the course of the day? How many times are they trying to push price back again? So it's just an advanced way of analyzing the data, but it certainly has had merits for us. I mean, it really, you can go through and just do some of it by eyeballing it, but if you dig into the data and start looking for, persistence in the buying and selling, it can really add to the bottom line. I'll show you some objectives or some examples of those here in a second. So the objective with the XRV setup is different than the straight up fastball. So if you're just scanning for the fastball setups, particularly if you're scanning NYSE securities, then you're going to target natural support and resistance. If you're doing this XRV kind of a setup where you're trading runaways, you're trading things that are going to have a real high probability of just popping the next morning again, then the objective is going to be either the first floor trader pivot or about $1 a share in profits, whichever one of those comes first. So it sounds kind of arbitrary, the $1 per share, but it's just the way that it's worked out. We've been trading this as a strategy, Julie and I, for a couple of years. We've had the guys on it for the last, since January. We opened this up as a subscription. First, we opened it up to 20 people, and then we increased that to 30, and now we're going to increase it to 40. Has to do with the liquidity, and I want to make sure that my ability to get in and out isn't hampered, and that the guys who subscribe to it isn't hampered either. But $1 per share has been the sweet spot, or if it hits one of those floor trader pivots, it really tends to bounce. And if you don't know what floor trader pivots are, then just shoot me an email, and I will send you a little blurb on how to interpret floor trader pivots. So in this case, for a long position to trigger, what I'm doing when I automate this is I'm telling my software that the price just has to be less than or equal to the prior session's high in order for me to trigger into the trade. Or I might say, if it's a long, I might say, a nickel above the high is the furthest that I want this thing to open in the morning and still trigger me in, because I don't want to get caught getting into a long trade as price comes down from above. Okay, if we closed at $50 and we open at $50.60, I don't want to get filled at $50.10 as price is moving lower. What I want to have happen is, if it closed at $50 and it's a long, I want to know, does it open less than or equal to, let's say, $50.05, and then travel up through that trigger price to get me in the right direction. That's all that means. So for a short position, same kind of a deal. Stock's price has to be greater than or equal to the prior session's low, and then I'm going to look to enter as the price starts moving down through my trigger area. So the triggers are going to set up just about the same way as for the regular fastball. The difference is, since these are automated trades, you're going to want to make sure that you configure it to validate your entry price. So generally speaking, on any of these, right, this is what the setup is going to look like on a daily chart. This is what MetaStock is going to screen for you. This is what you'll screen if you're just flipping through charts. You want to see that you've got some sort of a trend move, then you've got a counter trend, pullback, and then you have that bar that has the widest range of the past 10 sessions. In this case, it opened high, it closed low. It's a short sale. We're going to look to sell it short the next day, 10% or 10 cents, below the low of the bar that created the setup. So what you're looking at here is always going to be from a daily chart when you're setting it up. So in this case, the big bar to the downside, the next day it opens above our entry price, comes down, ticks in, and then, right, you're off to the races. You're off to find your either your profit target, or you're going to wind up hitting your stop, one or the other. So here's one. Now this is already into the next, into next phase of it. So I take my data, I've already found the setups. Now I go and I set them up in my trading platform for execution. So here you've got your expansion of range, expansion of volume day. This was SRCL. And we can see sort of where the selling is if we're looking at volume by price data, or just look at the big volume bar at the bottom of the screen. But one way or another, once I'm in my trading software, I try to sort of pick apart what happened over the course of the day. We see we had a heavy sell-off in the bottom of the range. That's the kind of thing that I like to see for a short sale, that there was persistence, that it really pushed the stock hard. Then I look at the 5-minute chart, and I see I've got a really strong, this was a headline-driven sell-off that happened, and over the course of the day, $8 to the downside. So right away, what I do is start setting up my stop, and you can see I'm looking at a 60.01 entry in this case, and I have a 60.77 threshold for a stop. I would have to tick above that to get me out. And those are the levels that I'm toying with initially when I'm looking at this. And I'm really trying to figure out, in many cases, where was the volume as it was selling off. You can either do this with volume by price data, or you can go through and look at the tape. Right, but one way or another, you want to make sure that when you're putting in a stop, that your stop is sort of above a pretty significant amount of volume, because what that does then is says it has to go and chew back through that stuff again in order to come and take you out of the trade. And then if the stop winds up being too wide, what we do is just lower our share size. No reason to, if the stop feels like it's out of control, then there's no reason to be trading 1,000 shares on something. You might lower it to 500 shares or 100 shares or whatever you're comfortable with in terms of risk. You adjust by share size, never by the stop, because the stop has to be based on something that happened in the market, something that actually provided support and resistance on the intraday chart. So I can set these up a couple different ways, and this will apply to just about any kind of trading software. You're going to have either bracket orders, you're going to have OCO orders, or you'll have conditional orders. All these things accomplish the same thing. In this case, if I'm using a bracket order, what this allows me to do is say, if I move down through that XRV day low, that Fastball Setups low price, then I'm going to sell short at $60.01 stop and $59.90 limit. So that tells my software I'm going to route into this trade, and the worst slip that I'm willing to accept is about 11 cents. Then if I've got my short established, I've got my initial stop loss set at $60.77, and I've got my profit objective set $58.94, and the trade's just going to take care of itself over the course of the day. And what I can do as the stock moves then is I can just go and ratchet my stops down by just grabbing the lines on the chart and pulling it into place. Or in some software, you're going to have to go and just issue change orders, right, to change your stop. But there's a myriad of ways that you can accomplish the same thing. But the trade management right off the opening bell is just handled by the software, and it's already set up so that it's going to be a 100% exit for a stop and a 100% exit for a profit. And if I only got filled 470 shares of 1,000 shares that I wanted or whatever, it's not going to overfill me and wind up getting me long, on the position that I wanted to get into. So this is how you would set it up with a bracket order. And bracket orders have benefits. You can the whole order is structured. It's very easy to change the orders. That when the exit happens on one leg, the OCO component of this is going to cancel that other leg. I already said you can change them right on the chart. The downside to entering a bracket order primarily has to do with the amount of money that's impounded when you put the order out there. So using compliant routes is, you've got to do that for kind of any order that you're going to place, any type of order you're going to have to place. You have to make sure that the route accepts those kind of orders. But if you have 5 of these set up on a given day, the bracket order is immediately going to hit your margin. So you're going to lose the ability to add a bunch of trades over the course of the session. Whereas other order types, they don't do this, right? Other order types allow you to only have the margin affected once the order actually gets you in. So here's the way that this one wound up playing out. And, you know, we see it made the move. This is on an intraday chart. Now, the last one was a daily chart. Moves down through 60.01, right? And you've got your profit objective down and at $58.94, and it goes in the second bar and takes you down there. So very typical on these first hour trades. It's that they're going to hit your objective in the first 60 to 90 minutes of the day. Equally prevalent that they're going to hit your target or your stop in the first 5 minutes of the day. So a lot of times, 5-10 minutes, the volatility on these is extreme. So it just winds up carrying you right into the range that you were looking for a profit target in. So what if you have a bunch of these and you want to structure these orders? So here is from, you know, the day that I put this slide together. These were the stocks that were on the list for this XRV service. So you had, you know, 1, 2, 3, 4, 5 stocks. And if instead of using a bracket order, you use a conditional order, then you still have all this opportunity to get in with a conditional order. But when you look at this, you can see all those stocks together, $229 per share is what that adds up to for the long entries and the short entries. And if you did it with a bracket order, then you need $57 per share that you're going to trade. So if you want to do 1,000 shares, it's going to impound $57,000 to give you the $229,000 of buying power to trade this during the first hour with a bracket. But if you do it with a conditional order, then it's only going to impound your margin at the point in time that the money is needed to execute the trade. So let's look at the example from this. So we had RNG, right? There's the expansion of range, expansion of volume. You have all this buying pressure. This is the kind of thing you want to look for. You want to see that those little dips are then accompanied by big block trades on the tape. So this is where it's different from just the regular fastball setup. The fastball setup, you're just looking at the pattern. The XRV setup is all about, you know, we have an algorithm that goes through and sort of scrubs the tape and looks for and matches the buyer over the course of the day. So in this case, we would see, okay, every time buying picks up again, it's getting hit with a block trade. It's getting hit with another block trade, right? And then that tells us that we've got a very high probability that the next day we're going to get follow through because it's closing in the top of the range. It's going out very strong on very, very heavy volume. They were waiting for it to come back in. It didn't. Big order on the close typically. And then the next morning, if it doesn't open down in the range and it starts getting hit with buyers again, then what we're banking on is that it's going to take about $1 per share increase in the price before they're going to get done what they're trying to do. So if I want to structure this as a conditional order, I do things differently. Now this takes a lot more time. This takes me about, I would say it takes me a good 5 minutes per trade to get these conditionals set up and nested. This is in my trading software, right? If MetaStock ever puts together a full-on trading platform, then I won't need a trading platform anymore. I can just go straight from my scans to my trades, I guess. But in the interim, when I set up a conditional order, I tell it if RNG's last price is less than or equal to 61.90, the high of that session, then I'm going to buy at 61.95 is where my order is going to go live, and at 62.05 is the worst slip that I'm willing to accept. So this puts the order together in a way that is only going to impound money if price starts on the right side. That's when the order is going to go live. If it's less than 61.90, then there's going to be an order out there. And when the condition is met and the order is marketable, right? I'm going to get filled between, I'm going to get filled between that stop and that limit price. And then I need to structure dependent conditional orders to get me back out of the trade again if I got triggered in to begin with. So now in the case of my software, I have to set up the OCO component of this. Some other trading software, you can set up a three-legged order where the OCO is set up like a bracket order and has a condition. That would be very nice, but I don't have that opportunity, so I have to go and set it up. I say I'm only going to have an exit order if the first order was filled, and then I'm going to have to tell it, manually that I want it to trade only the number of shares that I got into going in. I'm telling it now adjust the dependent volume. If I didn't get 1,000 shares, I only want, if I got filled 575 shares, make sure you adjust the dependent volume for the fill and then get me out of the trade with the same number that I got in. And in this case, this is going to be my profit target, which is a limit order. And then I have to go and set up the exit order for a stop loss. And if my stop price was at $61.40, I'm going to set everything up the same way. I'm going to tell it, I just want to get out whatever number of shares I got into. And I want to make sure that if it hits my stop loss, then it's going to get me right out. And if I didn't get filled at all, it's going to delete that order. So it's a little bit more complicated, especially with the software that I'm using, but I've been using it for a long time, and that's just the name of the game. Every now and again, they come up with an easier way to do it, and if that's ever the case for me again, then I will definitely take them up on it. But here's the way that this one played out. Again, you've got your entry zone is between the high of the prior session and 62.05. So that's the range of entries that were acceptable for me. And then $62.95 was my initial target on the trade. And you can see the stop was based on that support and resistance going into the closing range the prior session. So that is how these XRVs are playing out. And I have to say this is probably the most profitable thing that I've ever put together. So in 22 years or so of trading, this first hour trading strategy is really the thing that's booking the best numbers for us. And I think it's just because you're so focused on that prior session's aggregate momentum and the reason behind the push that it just has an incredibly high probability of following through the next day. So again, now let's look at the impact of those conditionals versus the brackets. CYBR that day was no trade, so there would have been no impound. LXFT that day, there was no trade, it never triggered. RNG triggered and went to a target. RUSHA had no trade. And USFD opened, traded up to the target and back down again, right? So we had two of the trades triggered and 3 did not, leaving us, total excess equity, $23.72 per share is what actually had to be used, or $23,720 per 1,000 shares. All righty, let's just move on. Okay, so, what have you done for me lately is always, what I want to know when I look at what's going on with something. So these were the setups today. This is this XRV scanner on Trader Insight, and you guys can all have access to this. We'll talk about this in a minute. You get do a little open house for you MetaStock folks. You can see today we had 4. We had APAM, CBM, KLXI, and WCC. And so again, generally, so we're targeting $1 or we're targeting the pivot. So on Monday, we had a real big expansion day, right? So Monday we had really wide targets because we had one of those overnight tweets and it made the market go crazy. So we had giant range on Monday. That meant that all the setups from Friday, had really good follow through on Monday. And then Monday we had setups for Tuesday that had very wide profit objectives. Then yesterday was a narrower trading day. Things just sort of sat on the hands over the course of the session. It closed where it closed, but there wasn't as much momentum. But we had these 4 stocks that came up. And even though they were on slightly narrower range, you can see there on that little inset chart, yesterday's bar is that big red bar to the downside, and then today's bar, the follow-through bar. You can tell, again, it just got you in, and then, boom, straight down to your target. So today, APAM, 60 cents per share. That went straight to its target. So the target on that one was down to $29.73 because that was the first support, and it was a short. CBM, 58 cents per share, same kind of a thing. We got into it, and then your target is going to be your first support, or on a long side trade, your first resistance. KLXI was 30 cents per share, and WCC wound up being $1 per share. So, as I said, these have been real strong for us. The guys like them, the guys who've been to the boot camp. Hands down, this became their favorite trade in a big hurry, and that's saying something since they're trained in how to do all of it. But for us, this was a matter of time management, and 20 years later, I don't want to retire because I love what I do, but I also don't want to sit here for 6.5 hours every day watching the screen. So that is the XRV trading setup. Here's what it looks like over the course of the year so far. It averages, I'm going to say, it feels like it averages about 20 points a month. It seems like it's been doing a little bit more a few months out of the year, but generally speaking, about 20 points per month, points per share traded, $1 is 1 point, is what it is going to fall into as, let's say, a sweet spot. So over the course of time, it has really worked out to be just about a dollar per day traded. Recently, we've had a lot more volatility. If that settles down, then it's gonna pull back in again, I think. But that's what it looks like over the course of time. So this is since the beginning of 2018. Now let's talk about gaps. So this is the other thing that we do. We trade an opening gap strategy that's going to be a little different than pretty much anything you've dealt with before. So I developed this. This was part of the work that we were doing when we were doctoral candidates. We were really looking at a lot of statistics. And the first thing that we did was had to figure out a proxy for volatility, because volatility data was, we used to use the implied volatility of the front month contract. And then what we figured out for each stock, so everything had to be calculated. Then what we figured out was true range is a real good proxy for volatility. And if you don't know what true range is, it's just like range plus the gaps. So you're looking at the greater value of either the high minus the low, which is range, or you're looking at the absolute value of today's high minus the previous close, or the absolute value of today's low minus the previous close. So it's true range, not average true range. You got to figure out the true range for every date. And I think this is the next thing that we're working on with MetaStock, is getting this put together so it'll just automatically scan for these, because MetaStock scanning capabilities are amazing. But so in this bar, right, here's your range. And then if you add the prior sessions bar and you go to the close of the prior day, that's your true range. So if today the high price was 50.10 and yesterday the close was 49, then true range for that day, $1.10. Now, why do you want to do this statistic to begin with? So you're assuming that market data is normally distributed. I can tell you it is. I did tons of research on this when I was much younger than I am. Market data is normally distributed. True range is a proxy for volatility, and volatility is mean reverting. These are all things that I've done research on over the years. These are all things that I've published on over the years. We know all that, and the reason that it's important is it gives you access to this thing. This is what's called a standard normal distribution. And what it tells you is that if you're out in those red zones, those are 1 standard deviation away from an average. You've got a 68.2% chance that price is going to move back toward the average. If you go out 2 standard deviations, now you're up to 90, you've got 95% confidence that price is going to drift back towards the mean, that volatility is going to drift back towards the mean. And that gives us a real good tool then for handicapping opening gaps, because people try to trade opening gaps every which way, and I've never understood why no one tries to put a statistic behind these things so that they can have a better probability of success. We did it, it works, and we do this every day in our first hour trading pit. We do this live with the guys. I don't run this particular trade. For everybody, this is a fellow named Rick Kipp. He's one of the boot camp alumni. This is the trade that he gravitated to, that he's made his living with for the last 6-7 years. And he just talks through what he's doing with every one of those trades. He's an uncompensated volunteer who just likes talking about what he's doing and likes the community that we have. So when you know that volatility is mean reverting, and you have your data is just this is what MetaStock is going to do when this data is put together. MetaStock will take the true range for each one of 10 days. It's going to take that. It's going to plug it into this formula. Standard deviation is X, which is the true range, okay, for 10 days, minus the average standard true range. So true range for each day minus the average true range squared. That's going to get rid of a negative number, divided by n. So we're doing n, not n minus 1 if you guys are engineers, or there's a very small sample size. We're only doing 10 days. And that average is just simply the average of those 10 days. The n is the count, and you take the square root of that to get rid of the square, and that gives you 1 standard deviation. And 1 standard deviation is going to be 49 cents. You're interested in 2 standard deviations, so the software will go, it multiplies 49 cents times 2, 98 cents, and then it's going to add it to that average. So that's how much the stock would have to gap then in order to qualify. So if these are 5-minute bars, and this comes up as being a 2 standard deviation gap, then what it tells us is that once this gap is in place, I'm going to keep looking for lower highs as a potential entry trigger. So when that first bar, so the bar way up high is yesterday's closing bar. The bar that we're pointing to with the arrow, that's today's open. So that's the first 5-minute bar. Then you've got a second 5-minute bar with a lower high. Then you've got a third 5-minute bar with a lower high. So if that third 5-minute bar would have moved up through the high of the second 5-minute bar, that would have been an entry trigger. Then we have that fourth 5-minute bar. That winds up being the lowest high. And when the next bar moves up through that high, that triggers us into the trade. And generally speaking, what we're looking for is something major that happened in the first bar, usually the open. So as a target, you would target either the open, you would target the high. We talk through all those things in the room every day. It's sort of a consensus trade where we're picking it apart live in real time and just saying, all right, look, here's what happened in the first 5 minutes. This is a really important level. If it gets back to that level, it's likely to reverse. That's going to be our target. So in most cases, as I said, it'll wind up going right back to the opening tick. This is on a gap lower. And, overall, this trade, I'm going to say if you're in the room watching with us over the next week, then you're going to see that day after day after day, what you can do by using the statistical, you're using a process control on this thing. What this allows you then to do is take a ton of gaps and narrow that playing field down to just the 1, 2, maybe 3 gaps that actually make sense to trade. The way that we handle these, this should have been one of the first questions you had is, well, what if the second bar moves through the extreme of the first bar, how do you handle that trade? Got a bunch of tricks that we use that are just simple, right inside your software kind of tricks. We would use on a short entry, right? We've got a stop right up above the bar that creates the entry, and then how do we determine the profit target? Usually we do a fib study. So I'll just use 382, 50, and 618, and then use the expansion correlations for those as well. So 1.382, 1.5, 1.5 is usually the target, and then 1.618, that would be an extended target if you just blast through through that first target. So that's how we manage the positions on these. They're, universally, if you're waiting for, for the scan from MetaStock on this, it's going to be a good one, because it's going to go and, take a lot of the guesswork out of it for you. But once you have it, again, as with all my trades, you have to go through and you have to figure out, where's my stop? Where's my target? Where am I going to get into this thing? Right? And just sort of know in the back of your mind what the reasoning is for, all three of those things. So when we enter these orders, it's the same kind of a thing, right? Now, these I will definitely do as brackets. Because I want to be able to set up the whole thing on the fly. And what I'm doing is I just took $35.92 is going to be the stop that gets me live. In this case, I use very, very tight limits, because price wiggles around an awful lot on these gaps. It's really, really heavy volume. You don't need to build in 8 or 9 cents of slippage. You can pretty much do these with a penny, 2 pennies, 3 pennies of slippage. And then I just like to, I just get them all set up so I know exactly, okay, I'm going to get out $36.30 is going to be my stop loss. 35.03 is going to be my profit objective. And then if that second bar doesn't wind up going down and creating the entry, then I just go back through and make adjustments. I just change this order. And I've got a macro that just pulls the order back up again, allows me to change the values. All right, so I'm just going to tell you quickly about a little offer for you guys if you're interested. So I don't want you to buy anything, right? I want you to take a look first and see if it's right for you. We are a small outfit, and it's just easier for us if you come and take a look at what we're doing for a week. So to sign up for a week-long open house of the trading plans, this will include my around the horn plan, the scalper plan, the XRV plan, and the first hour trading pit where you do the Baltimore Chop. So you get to see everything. Go to traderinsight.com/metastock, just like it is on the screen. They're all lowercase. And then what will happen is you can fill out that form there. Make sure you include your phone number. You'll get a call from Victor. It'll ask you to schedule a call with Victor. He does client relationship stuff for us, and what he'll do is he'll go and walk you through how to use the site. Because every time that I've done trials, or even paid trials, what winds up happening is people can't really figure out where something is, and then they just give up and they don't take advantage of all that stuff. So this way, you get a call. It'll take 15 minutes. He'll walk you through. He'll show you exactly where everything is, exactly how to use everything, and then you can give it a really good, week-long test drive, kick the tires, see what you think of everything. He'll answer questions for you over the course of the week. And then if you do decide that you want to become a member of the services, if you do the XRV trading plan, we'll give you the first hour trading pit along with it for the duration of your membership. And then if after 30 days you're not making money with it, or you don't think it's for you, then you just tell us and we'll refund it. So I don't, as far as I'm concerned, I want nothing but happy people at Trader Insight. So if you guys find it works for you, then fantastic. I'd love to have you. And if it doesn't work for you, that's I'm sorry to hear it, but I would prefer to just give you your subscription money back and have some happy clients. So that's it. That's what I've got for you in terms of what I do, how I do it, why I'm doing it. Right? We've made a lot of changes over the years to how much time we want to put into this stuff every day, and I will take questions if you have any, and I will let Jeff talk to you about the MetaStock plugin as well, since I know a lot of you guys are looking for trading ideas every day. I think it's one of the best tools out there for generating ideas.
Okay, well, great job, Adrian. I did. Let's see. If you do have any questions, feel free to type them in. What I'm going to do is what I want to do is actually just show you the process of the add-on, of kind of finding these, particularly the around the horn add-ons and the add-on pattern strategies. So in around the horn, I've actually got a picture of the book right here, or actually I've got the book right here. Give me just 1 second. This isn't okay. So right here, we've got a copy of the book. The list price on it is about $95. It's a really good book. In it, it kind of outlines kind of all of the patterns. It shows you exactly how they work, all of that kind of stuff. And what I want to do is I want to show you how these would be implemented in MetaStock. So for example, Adrian had talked a lot about the Fastball strategy. And so let me go ahead and with the Fastball strategy, what we actually look for is we look for a pullback or a consolidation in an uptrend. We look for stocks to break out of that pullback or that consolidation channel in the original trend. And so I've got a MetaStock chart up. This is a scan that I ran. I'm going to show you how to run this scan in just a second because it's very, very easy to do. But basically, kind of along the lines of what we're looking at is if we just wanted to kind of draw a little bit of an uptrend on the chart right here, this is what we've got. And then you can either have a pullback or a consolidation channel. In the case of Kellogg, what we've got is we've got a little bit of a consolidation channel that kind of happens for these 3 bars or so. So right here, we've got our uptrend, we've got our consolidation channel, and today we had a breakout, which is why it's issuing for us, it's issuing a signal to go ahead and get into the marketplace. So what I'm going to do here, since I've ran this scan, I'm going to attach the what we call the expert advisor for those of you that don't have MetaStock and just kind of show you how it works. So if we go ahead and click on View Expert Commentary, I need to attach the Fastball set patterns to it. So I'm going to come down here to the around the horn patterns. You can see them all kind of listed out right here. I'll just attach the one called Fastball. Okay, I'll go ahead and click on Close for it. Oh, looks like I need to try that again. I had to hit the Attach button. Okay, and you'll see right here we had a little bit of a buy. There was a buy that was generated here, but based on the rules that we just learned, this wouldn't have actually generated a trade. So here we've got the buy pattern. It's going to spell out for us the Fastball is indicating a possible long entry. If you're interested in taking advantage of this trade, you should look to get into Kellogg Company about 69.08 or higher. You should look to place a protective stop at a key support level. You should also look to take profits in this position as a key resistance area. So it kind of gives you the whole game plan about how to take in this case, the Fastball trade, but any of the patterns that we've coded. And what we coded from the book were all of the single day patterns, or all of the multiple day patterns that worked really well for scanning. And speaking of scanning, I'm going to just basically show you how I came up with Kellogg today. So if we come into the Power Console, and go ahead and click on Scan. And when I do that, what you're going to see is I've got the ATH. I've actually saved them as part of my favorite scans. So what I'm going to do is I'll just show you the Fastball scan. I just ran a real quick scan. What I did is I did it against the S&P 500. Okay, so I've got S&P 500 selected. Regardless of what market you're in, you can use whatever instruments that you're interested in. So we'll go ahead and start that exploration. It's just going to go through the S&P 500 for us. Here's the exploration wizard, and it's just going to basically go in and give us a list of all of the stocks that had this type of a pattern. Okay, now you can reverse this pattern as well. It'll give us long and short. So in the case of a short, it's going to look for a downtrend followed by that consolidation pattern. Okay, and it started to pick up some speed here. Usually it's a bit faster, but right now I'm broadcasting and I'm broadcasting audio. So it's fairly bandwidth intensive, but I'll show you what the reports look like in just a second. Maybe, as soon as it's done here. Okay, it's about halfway done. And again, it actually runs quite a bit faster when you're not broadcasting yourself over the internet, as well as your screen over the internet. So it only took me maybe about 10, 15 seconds to run earlier today, but in any case, it's getting there. So I don't see any questions. Do you guys have? If you do have questions, go ahead and feel free to kind of point them in here. And we'll just let this finish out. It's almost done. I'll let you look at the list of patterns too, again. So again, of all of these patterns, they're all very visual patterns. What it's going to be looking for, they're scans that are built around all of them. So you've got the backdoor slider, the double header, the fastball, the infield fly, the line drive, and the switch hitter. So here it's done. Okay. Very simply, here's a list of the buys. In the S&P 500 as a buy signal, there was just Kellogg today. That's it. Okay. You do notice quite a few sell signals. That's kind of indicative of a day that we had a fairly major sell-off towards the end of the day. If you wanted to kind of take a look at these, what you could do is you could save the list out. I can also just double click on them. So let's say we wanted to look at paychecks. The paychecks would be, again, a short signal. And so I'll just go ahead and double click on that to open up the chart. And it should open up for me fairly quickly here. Go ahead and close this exploration down. And with paychecks, here you've got your little bit of a consolidation pattern. You've got that breakdown of the channel. And if we attach that expert advisor again, what it's going to do is it should give us a short signal for today. Okay, and there it is. And again, what you're going to get is you're going to get the exact entry price and exactly how to get out of that stock. So that's built for all of the patterns that are built into the book. Okay. The add-on itself, again, is designed around the strategies that are in Adrian Manz's Around the Horn book. And the cost on it is actually very, very inexpensive compared to the add-ons that we release. You can own this as a one-time cost of $299. We're going to do a webinar special today. It's $199. It's a one-time cost. You pay for it. You own it forever. If you need a copy of MetaStock to go with it, let's say you're new to MetaStock, you haven't started using it yet, we'll give you a trial access to the MetaStock program. And one of the things that we just found is we found a box of these Around the Horn books. There's not very many left. It was from a promotion that we ran with Adrian a few years ago. We got away almost all of the books that we had. But we found about, I'd say, between 20 and 30 in a box. And so what we're going to do to kind of sweeten this offer a little bit, this book, if you look at the retail price on it, is $95. So what we're going to do is if you live in the US, we're basically going to go, we'll drop it off at FedEx for you, and we'll give you an absolutely free copy of this book. Okay. If you live internationally and you want a copy of the book, depending on the country that you're in, we'll have you pay for the shipping costs. If you're in Asia, that can be relatively expensive. It can be up to $60. In Canada, it's not so bad, but we'll have you pay our actual shipping cost, but we'll still give you a copy of the book. So again, the offer for that is $299. For coming to the webinar today, we're going to give you $199 for that. We're going to back it with our normal 30-day money-back guarantee. And in addition to that, we're going to give you this Around the Horn book. Now, the Around the Horn book was actually, if you look at it on Amazon, you're going to see that it's got a 4.5 star rating. It's a great book. And it's worth $100 just by itself. So there you go. I want to say thank you for coming to the webinar today. Adrian, thanks for your time. And as always, we'll see you at the next webinar.
All right, thanks, guys.